Thanks, Amy. I appreciate everyone being here today for our third webinar in our Inspired Perspectives series discussing the Inflation Reduction Act. I hope you made it to the first two in our series. If you didn't, just to recap, make sure that you reach out to Eide Bailly folks. Our first webinar covered business incentives available through the Inflation Reduction Act, specifically 45L 179D. The second was opportunities available for tax exempt entities. That's something new that came out of the Inflation Reduction Act. So again, if you missed those, please catch up with someone within the Eide Bailly staff that can help you with those incentives. Today, we're talking about opportunities available to individuals, and I am joined with two fantastic presenters, a familiar face, Joe Christon out of our Des Moines office, and a new face to Eide Bailly. I'm happy to introduce Kerry Gordon. Advanced slides here so we can see our presenters. Kerry is out of the Denver office. He joins Eide Bailly from PwC. He has 40+ years of experience in energy and natural resource tax matters. He served in the policy office of the Department of Energy and supported mergers and acquisition transactions for clients of PwC. We're very happy to have him here today, and of course, happy to have him at Eide Bailly. So welcome to everyone here, and I think Joe, going to pass the baton over to you.
Okay, thank you, Jenny. When we were talking about what eventually became the Inflation Reduction Act, we thought we might be seeing an awful lot of changes to the way we do business on the tax side. There was this whole menu of things that were being considered, everything from millionaire tax to increase in the state and local tax deduction on Schedule A to big changes in the estate tax. But as it came out, Congress definitely shortened my portion of this presentation by greatly limiting the amount that would apply to individuals. For the most part, the only thing that we're going to see that will apply to individuals that was on this big menu is an indirect application by an increase in the IRS enforcement budget. And so what do I have to talk about? Well, there's some revenue raisers. There was the corporate minimum book tax, which applies to very large corporations. Share buyback tax for public corporations, which might apply to people indirectly. The only direct individual revenue raiser that we really have to talk about is an extension of the excess business loss limits through 2027. Things that were left out: statutory rate increases, any significant change at all to the estate and gift tax rules, any increase in the deduction for state and local taxes on Schedule A, modification of the carried interest rules, limits on mega IRAs. All these things were left out of the bill that eventually became the Inflation Reduction Act. So the big thing that we have in the Inflation Reduction Act that applies to individuals are the loss deduction rules. The tax law has, for individuals, 4 basic hurdles to clear if you're going to take a loss for business losses on your tax return. First is basis. You have to have basis in the activity to take a loss for it. That basis has to be at risk. Then you have to be non-passive with respect to the activity. If you clear all those, then you run into the individual business loss limit hurdle. 2017 tax law imposed Section 461L, which limits the amount of losses that can be claimed on individual returns to a flat dollar amount. The limits were waived as a result of the COVID epidemic, but they are back for 2021 and subsequent years. And the limits are 250,000 for single filers, 500,000 on joint returns, adjusted for inflation. So on 2022 returns, it'll be 270,000 for single filers, 540 on joint returns. What's business income and loss? It's all combined deductions attributable to trades or business of the taxpayer. Wages don't count. You ignore 199A, you ignore loss carry forwards, and you ignore all the stuff that isn't considered business income, dividends, interest, pension income, things like that, capital gains. That is all non-business income. Best way to understand it is to look at an individual example. Here we're talking about Emma, a single taxpayer who owns all of an S corporation. The S corporation gives her a $500,000 K1 loss. She has a $300,000 salary from the corporation and $300,000 in other non-business income. When you go through all the limits, she finds out that her income before itemized deductions ends up being $330,000. She has $600,000 of non-business income, her salary, $300,000 of other income. She has a $500,000 S corporation loss, but because that's limited to $270,000 under the excess business loss rules, she has to add back $230,000 of that, and that $230,000 excess is treated as a net operating loss carry forward to the next year. And had she taken less of a salary, she would have a better deal because she would have had a smaller excess loss, and she would be better off from a tax standpoint. All business loss counts, so you don't have to do this on an activity by activity basis. You can have $1 million loss offset $1 million income item as long as they're both business income. So that's a common question that we get. And so it's an aggregate thing, and it takes into account all your business income and all your business losses. Provision was set to expire after 2025, but it was now extended in the Inflation Reduction Act as a revenue raiser 2 more years. I think this is likely to be extended indefinitely, perhaps a year or 2 at a time, as a revenue raiser to offset other tax breaks or spending in future legislation. One thing that didn't happen was a lot of people think that 461L should not generate a net operating loss carry forward to the subsequent year. Instead, it should be a separate business loss carry forward that will be tested every year under Section 461L. As it stands now, those losses are only tested once under 461L, and then they become an NOL carry forward. The other thing that the Inflation Reduction Act did was it extended enhanced premium tax credits through 2025. This reduces the percentage of income contribution required for premiums, and it allows individuals with household income exceeding 400% of the poverty level to obtain premium tax credits.
Well, good morning. My name again is Kerry Gordon. This is, starting off the issues that, most of us taxpayers, have to deal with. When do I get something and what do I need to do to get it? So this is a beginning of construction guidance, that has been repeated by the service multiple times, and so we all feel very good about this. If you work in other provisions of the tax credits as well as depreciation, beginning of construction start, your ability to claim both provisions because, Congress grants certain things on when the construction begins. The record keeping requirement, I think, is very important to this process. As you will find, we talked about new IRS agents the numbers, debatable, but, new IRS agents, they're going to be looking for something to do. So documentations are very important. I've had, clients with very large facilities that literally did not document what they did. And they had to go back and recreate costly events. So I think this is a great segue to the rest of this discussion. Certain things trigger a credit, certain things trigger depreciation, but Congress has given this guidance that allow you certainty that when you start something, you're going to get them. You're going to be able to claim the provisions on the date that you started. Gives economic certainty to many things.
And just as a follow-up to that, Carrie, there's not many provisions, if any provisions, that affect individuals within the Inflation Reduction Act that rely on this labor guidance, right? This was recently released, and we wanted to make sure that there was a little discussion in our third and final webinar that the labor guidance has been released. Is that correct?
That is correct, yeah.
Okay.
And it puts a lot of the burden on, developers to do the work, for you. So in this case, manufacturers of automobiles, they're going to be doing this work.
Right. So this is specifically prevailing wage and then the apprenticeship requirements.
We'll start off, really where individuals could come into account. Specifically, there is a new energy efficient home credit, under 45L, it's been modified, let's say a modified energy credit. Historically, it was, a credit, that was distinguished between manufactured homes, you could refer to them as, trailers or whatever other term you use, or, specifically some prefabbed houses, and then single family homes. Those are the two distinguishing groups of credit available. The new 45L, I'm gonna have trouble talking today, but anyway, 45L does two things. It does give, a potential for a different credit based upon, this meeting certain criteria. So it will raise or lower the credit according to meeting specific criteria. And it does break down, more of an incentive, to certain types of multifamily apartment type development that would occur. So it is one of those that it will be in the area where a business would be claiming this more than the individual. So if you're in the construction business, these items are important. The general overview of this section is that it had to achieve a 50% reduction in energy consumption. Energy consumption in residents is primarily in the building envelope, in other words, the floor, the roof, the ceilings, and the heating and cooling equipment and lighting. Those are the three things that, we normally look to. So I think we can, unless you got something else to add.
Absolutely. And just as a reference back, our first in the series, before you started with us, obviously, Mark Rogers and his group did a great job diving into 45L. So Amy has included that link to that YouTube video. So please make sure that you take a look at that. Okay, so moving on to the energy incentives for individuals. Here's the list of the incentives that we'll cover. And kind of the outline of what we'll do is talk about what happens for 2022, and then of course what it's going to look like as we start the year in 2023, because a lot of these incentives and credits change pretty dramatically in 2023. Some don't, some do take a dramatic shift. Whoops. Amy warned me of the delay. The first that we'll talk about is the plug-in electric drive vehicle credit. Of course, this is the title, the name of the credits in 2023. And this is probably the individual credit that's received the most media attention, specifically of late, that Carrie will get into in a little bit. Really, we have to look at the dividing date of August 16th, and that's obviously when the Inflation Reduction Act was signed. So August 16th is a critical date when we talk about the clean vehicle credit, formerly known as the plug-in electric drive vehicle credit. They made it a little easier for us. So the credit is what it is prior to August 16th. If an individual purchased and took delivery of the vehicle prior to that date, they are entitled to the $7,500 credit if their vehicle that they purchased obviously qualifies. A link is provided there so you can see a summary of those vehicles. This is a $7,500, up to $7,500 non-refundable credit based on battery capacity. Kind of some things that do not apply prior to August 16th are the North America final assembly requirements. We'll talk about that in more detail in just a second. These are new vehicles only for use or lease, not for resale. And there's that 200,000 vehicle cap that is still in play prior to August 16th. So Tesla and GM have met that cap. So those vehicles in 2022, throughout the entire year actually, are not eligible for the credit. So again, this is prior to August 16th. Okay, so what happens if I've made a deposit, right? Put a deposit down on a vehicle. I have a written binding contract, but prior to August 16th, but take delivery after August 16th. Well, the same $7,500 non-refundable credits based on battery capacity. North America final assembly requirement is not in play, but we do have to have this written binding contract, which is defined by the IRS in order to apply for the credit. And delivery has to be taken by December 31st of 2022. Joe, you turned your camera on. Do we have any commentary to share?
Not right at the moment, but as you go on, I might.
Okay, Carrie, are we okay to move on as well?
Yeah, let me just throw this in, quickly, is that, this credit was the most responded to when the Treasury went out and asked for comments on, guidance on this bill. The writing regulations in this credit was the focus point of many, many parties. Simply stated, the manufacturers are struggling with, the guidance here, because it was, not totally complete, from the statute itself. And there were lots of fears being pitched out there. And I want to say, I gave up counting when they hit 18,000 comment letters submitted to the Treasury. It was high concern. Treasury, or through the IRS, has issued, some formal guidance now, and it should quiet down these provisions. In other words, they're giving the ability of the manufacturer to make a lot of the determinations for the consumer, and they're also, giving, some leeway in the statutory provisions to say we'll allow, various types of components to be, manufactured elsewhere and brought into the United States.
Okay.
And there will be a lot of pressure to continuing on this, both because of the limitations of sourcing that U.S. manufacturers are running into, and pressure from our trading partners who are upset that their products are being restricted from getting this subsidy. And so I think we'll probably continue to see some erosion of some of the made in North America provisions of this, but I don't think there's going to be a great change, certainly in the next year or so.
Perfect. So thanks. And those particular pieces of the provision aren't applicable for 2022, right? The battery
Yes.
source of the battery, and then the critical materials.
Yes.
So the really only change to the credit for 2022 is after August 16th, we have this new final assembly in North America. Okay, so that's for any purchase and delivery within 2022. Okay, so what happens beginning January 1st of 2022, right? Joe and Carrie alluded to two new requirements. The critical minerals must come from the US or a country in which the US has a free trade agreement. And then we have to look at the source of the battery components. They have to be manufactured or assembled in North America. Okay, so 40% of the value in 2023, 50% of the value in 2023, respectively, for critical minerals and the battery components. These, of course, ramp up, and we have a slide coming up. The percentage of these amounts increase gradually over the course of time. There's also vehicle price limits. New SUVs, trucks, and other passenger vehicles are limited. Let's see, $80,000 for pickups, vans, and SUVs, $55,000 for sedans. So that's a new component of the credit that wasn't true in 2022. The 200,000 vehicle manufacturer cap is lifted. So in 2023, GM and Tesla are available if they meet the MSRP requirements. And then, of course, we have the modified adjusted gross income limit. That's $150,000 for single, $225,000 for head of household, and $300,000 for married filing joint. And we can look at the last tax return or the previous one to meet those limitations, to see if the taxpayer meets those limitations. So you can see here over, like I said, over the course of the next two slides, how those percentages are ramping up through 2026 for critical minerals and 2028 for the battery components. Carrie, Joe, any last comments?
I'll jump in here. You know, just for everybody's understanding, critical minerals are primarily the metallized metallized chemicals that, you know, go into battery production as well as steel manufacturing. You know, historically, those activities have been moved out of the United States. I think there was a publication yesterday that said most critical minerals are 80% produced in China, some Russia. You know, but in the United States, it's very low. Let me say, like in the, you know, the tens of percent, less than 5% in most cases. And so those same minerals are available to the United States. And, you know, it doesn't mean that we couldn't, you know, have those minerals produced in the United States or manufactured in the United States. And this is kind of the Congress incentive to bring those activities back to the US. Remember, Senator Manchin was really the primary party that was trying to get provisions in here focused on the United States. This is one of his success areas.
Right, so really a challenge to the industry, right? Both that industry, but and also the manufacturers. I also just want to briefly comment on the revenue procedure that was recently released that continued to confirm the fact that the responsibility for reporting this information falls on the manufacturer. This is not the individual taxpayer's responsibility to determine if the vehicle qualifies. The real responsibility falls on the manufacturer to make that determination. Additional information, in 2024, there will become a program for direct transfer of the credit to the dealership, which can be used as a down payment or a sales price reduction. This is going to be really beneficial because it's an immediate benefit to the taxpayer to be able to reduce that sales price of the vehicle. Also, because it's a non-refundable credit and it can't be carried over, those are two additional incentives to use that. Plus, immediately they get the benefit of this. That will come with a fee to the dealership, because so there will be some incentive there for the dealership to participate in those programs. It expires in December of 2032, so we have this one for a while. There are a variety of state incentives, and I think we have to continue to be aware. Of course, we're talking about the Inflation Reduction Act. That's specifically federal incentives, but states are doing quite a bit for clean energy incentives as well. If you want to take a look, Form 8936 is available in draft form.
Let me jump in here just quickly. One of the things, that for those who like to negotiate, go in the dealership and negotiate. This is another item that's going to extend your period of negotiation. So whether you trade it to the dealer, ultimately, it's like anything the dealer can do for you. He can either discount or he can find some other arrangement. All the tax credits, the congressional intent was to keep more of the value of the money in your pockets as opposed to having them taken off by financial transactions. And so ultimately, you're going to have to do the negotiations to get there, but it will be in the periphery of many options the dealer will be trading on.
Perfect. Thank you very much. Okay, moving on to our used clean vehicle credit. This is brand new opportunity to purchase used vehicles. The lesser of $4,000 or 30% of the sales price, not to exceed $25,000. There is also a modified adjusted gross income limit. We'll take a look at those limits in just a second on a future slide. Interestingly, there's no North America final assembly requirement at this time. The vehicle must be at least 2 years old, with the recipient of this credit being the second owner. Similar to the new clean vehicle credits, there will be a direct transfer in 2024, but this credit is available beginning January 1st of 2023. The purchase needs to come directly from a dealer, and again, in reference to revenue procedure that just came out, there is some additional responsibilities to the dealers, and we'll continue to talk about that in future webinars and conversations, but there is going to be some reporting requirements for dealerships. The taxpayer is allowed to take this credit every 3 years, right? So the dealership piece eliminates that direct transfer of used vehicles without the dealer involved. I know this is really small, so please pull up your slides and take a look, but this is a table that compares the first 3 columns are the new vehicle credit. And again, with that critical August 16th date, there's really 3 opportunities and 3 differences in the credit over the course of 2022. So it summarizes those 3 kind of opportunities, those 3 buckets of dates. And then also the used vehicle credits there on the far right-hand column. So you can see what the differences are in the amount of the credits. You can see the AGI limits there for used vehicles. You can see the MSRP limits. You can see how the cap is lifted in 2023 for Tesla and GM. And then some other considerations that we need to keep in mind as we're applying for the credit. Okay, refueling property. 30% credit for non-depreciable property not to exceed $1,000. Allowed on all property at each location. This is in 2022. The changes coming in 2023. Instead of at each property, we are able to take the credit on each component installed. It is still a 30% credit, not to exceed $1,000, but there are some new census tract requirements for individuals. This is an opportunity for the credit for businesses as well, but this particularly is for non-depreciable property at homes and residents. Carrie, do you want to speak briefly to the requirements?
Yeah, let's go back and, this provision, has been in, the act, for years. Historically, it was, for using corn ethanol, to put actually fuel into a vehicle to burn corn ethanol. Because of the recharging stations, necessary for electric vehicles, that really brings a different component, so I could get a credit for my vehicle, I can get credit for my recharging station itself. To be a recharging station, it must be bi-directional. And what that means is it can pull power from the grid and send power back to the grid. The value of that is, if you're in a storm area or whatever in your location, your utility can pull power off your battery that it was charging, to help supplement the power to the utility grid. And so ultimately, we talked about state incentives. Certain utilities are also providing incentives for these arrangements that, you would allow them to do this type of activity. So it's definitely something to think broad, federal, state, local, as well as, utility arrangements. What am I doing? Where can I get the most benefit from my expenditure? So ultimately, these are the individual's way of joining in the same type treatment that businesses would have.
Perfect. And just as a recap, because I do think this may surprise folks, the census tract requirements, because it was not a requirement previously. We are waiting some more guidance on this, but we do believe that taxpayers have to be in low income communities and possibly brownfield sites or adjoining tracts. So more information on that, but I do have a feeling that that might be a surprise to some folks as they're considering installing their property in 2023. This bidirectional charging equipment, that's pushing the envelope a little bit, right? What the act is intended to do. So this is the qualifying property that Carrie discussed that has not changed with the credit enhancements in 2023. So that slide is there for your reference. 25C is non-business energy property, originally expired in 2021. So this is, we went back retroactively. 10% of qualified energy efficient improvements. The big challenge with this one is there's a lifetime cap from 2026, or excuse me, 2006. Got my 20s in there. So 2006, if you're have taken this, you're not eligible in 2022 yet. So that $500 lifetime cap, you have to go back quite a ways. Qualified energy efficient improvements on principal residence. So that is, again, through the end of 2022. Beginning in 2023, this is one that kind of gets a lot more generous. We have a 30% qualified energy efficiency improvements in residential energy property expenditures not to exceed $1,200 annually. So that lifetime cap is lifted and that credit amount has increased to $1,200. Additional incentive for heat pump water heaters, biomass stoves, and boilers up to $2,000 annually. And again, there is going to be, similar to the reporting requirements that we're going to have with the vehicle credits in 2024, the qualified product identification number needs to be reported. So there will be some sort of report that needs to be run and assessment that needs to be done to match to make sure that the property is eligible. Qualifying improvements in property includes windows, and there are specific caps on each kind of improvement. So $600 for windows. You can see their exterior doors, $250 a door, $500 in aggregate. So again, you can have, $600 of windows combined with, doors not to exceed $1,200.
Can I jump in here?
Absolutely.
Okay, so this is, I'll just say generally, I'm going to be very specific here. The 20 series of the code are refundable credits. The 30 series are non-refundable credits. So this is a refundable credit. You know, even if you don't have tax liability, you will get, you know, the benefit of this. But this provision particularly, you know, does have, you know, you have to be paying tax and you will end up with a carry forward schedule to deal with. But here's a big concept that, you know, we talked about earlier, is this pushes the certification of these assets to the manufacturer themselves. So they would be issued a Energy Star certificate that they would actually place on their products. So you would see an Energy Star logo on the windows and doors and let's call it insulation or caulking materials. So you'll see all those things identified, because most manufacturers, I mean, most parties that come in and help with the building improvements, they likely may not be inclined to track all this for you. And so you might have to ask questions.
An interesting change as well as the principal residence requirement was lifted. So this is any residence. The draft form of 5695, Carrie will talk about that in just a minute, but that is available. So you can take a look for the requirements of 2022. All right, and 25D, residential energy efficient property credits. This is one that hasn't changed too much. Do you agree, Carrie, with the Inflation Reduction Act?
Yeah, we're good. Yeah.
Okay.
You know, this is definitely one that historical continues on.
Okay. So not much changes other than the percentage for 2022. Home use as a residence, except the fuel cell. Property expenditures must be in your principal residence. You can see there a list of expenditures, property and labor costs for installation. I'm visual and certainly not an energy expert, so I had to see some of these things. So here we can see the first couple of solar energy. You can see those rooftop panels. You can see fuel cell property expenditures, wind, and then the geothermal heat pump. I know that's something that's fairly common to us in rural Iowa because we have a lot of land in our backyard to install those, but I don't know how common those are in the rest of the country.
A new plot of land.
A new plot of land. You need a lot of space.
If you're building a new home, I see these things come in quite frequently. If you're trying to work in your existing neighborhood, your neighbors may provide comments.
Right. And this residential clean energy credit is available for existing homes as well as new constructions. So beginning 2023, like I said, there's not many changes. Majority of the expenditures remain the same, except their percentage that we'll talk about in just a second. We do have the ability to have qualified battery storage technology expenditures, and that's similar to what Carrie spoke about earlier with the bidirectional opportunities. If you're going to have bidirectional, we need somewhere to store that energy, right? Either in our home somehow or in the grid. So that's eligible for the credits as well, that battery storage. So in 2022, the credit amount is 30%, and that starts to go down beginning in 2033, 26% in 2034. This, of course, expires in 2035. Carrie, do you want to discuss the reporting?
Yeah, so, you know, we've actually walked through 3 different forms, you know, and the forms are not exactly favorable, but there are 3 different forms, you know, that individuals should focus on, you know, the 5695, the 8936 and the 8910. Those forms are very directional in what they expect the numbers to just be populated to really see whether you get a credit or not. So that's the purpose of the form, is really to say, okay, what can I actually put on the tax return, my 1040 or other claims, that would be made. So specifically, the documentation is important here because, like I said, some of this is being done by the manufacturer. The manufacturer should be giving you something to support your claim. So these are all, specific items to give consideration to. One of the issues with the plug-in vehicle being that it is a non-refundable credit. It is a use or lose, and it causes people to think differently about, okay, I can afford the electrical vehicle, but I don't have enough tax. What do I need to do to get that tax credit? And so parties are throwing out capital gains and IRA conversions and all these other things. Think through this thing broadly before you commit to buying electrical vehicles, because you might find out that your income, for what other reason, you had non-business losses or something else, that impacts you, or some other claim that you claim otherwise that could impact your ability to claim this credit. It's definitely something to think through. Like I said, do this before you go to the dealer, because they'll negotiate you away from it. So it's definitely something to consider. Each of these forms, again, that is 5695 for residential property, 8936 for plug-in vehicles, 8910 for alternative fuel vehicles. Each of those forms do have specific requirements, and they may stack credits differently than you expected.
Did you want to say anything specifically about credits coming through from flow-through entities?
Oh, yes. Okay. So now we're ending in the business world, because if you invest in a private equity fund or other partnership arrangement, those credits are flowing through on a different form, which is the 3800 form. Ultimately, those business credits do have a floor on them, that you can never offset credits to that floor of $25,000 in tax liability. One thing to think through, maybe we don't probably have enough time, but to think through is when you're dealing with a tax credit, you're dealing in after-tax dollars, where most people think of deductions, it's pre-tax dollars. So, there's some consideration, if you have multiple uses of credits and as well as investment activities, you might find yourself getting something that you didn't expect because your investments may be passing through credits. Publicly traded partnership is the common one that I see these credits pass through, but private equity arrangements or partnership investments are also the other way we see these things come through.
That's great. Okay, so I just do want to clarify, all the credits are non-refundable. The challenge just specifically with the clean vehicle credits is there's no carry forward. So the residential clean energy credit is available for carry forward, but not all of them. So I think that's the key consideration that we need to make sure that we keep in mind as we go to the dealer to try to negotiate these credits and purchase our vehicle. I'm one of those folks that likes to walk in and walk out with a car, so not a lot of room for negotiation for me. Just have to leave my husband at home in order to get that done. Now we're going to move kind of beyond the specific federal income tax incentives. There's two new, or I shouldn't say new, but there's two rebates that will be funded through the Inflation Reduction Act to be managed at the state level. I really don't think that these have received a lot of media attention. So just want to make sure that we're aware that they exist, because as states get funding from the Department of Energy, I think they will be picked up. So to make sure that they're not confused with federal income tax credits and the application of those on the return, these rebates will happen right at point of sale. And again, they'll be managed by the state back to all the Energy Star efficiency ratings and such that Carrie's already spoken about. Lots of information forthcoming. The states have been allocated their money, and that's kind of the extent of what I've seen. So the Homeowner Managing Energy Savings Rebates, acronym is HOME, is not new, but it is receiving additional funding. This is for either modeled or measured changes to energy consumption. So you can see there, if you meet a certain threshold of energy savings, 35% or more, you get the lesser of $4,000 or 50% of the project costs. So again, administration of this is not set in stone by any means. We need to have the additional guidance, but this will be a point of sale rebate that happens upon the purchase of the project components. You can see if we have less modeled energy savings, 20 to 34%, the credit or the rebate amount, not credit, excuse me, rebate amount goes down. And then the measured savings, you can see that there in that third bullet as well. So rebates amounts are doubled for folks in low or moderate income single family homes, multifamily buildings. The real incentive, real dollars come into play probably for multifamily homes. You can see apartment complexes and such, energy savings, $4,000 per dwelling, up to $400,000 per multifamily building. Okay, so some of these large apartment complexes, and Carrie, you can kind of speak to this, will see real savings through these rebate programs.
Yes, and moreover, it is to the building developer, in this arrangement that they could pass that price incentive down, down through the system. Will they keep it? Will they pass it along? Ultimately, this is a new market, and we're going to see, different incentives being offered by different parties.
Right, and as they become more prevalent, I'm concerned about the confusion between the different incentives. So, kind of laying that groundwork here. High efficiency electric home rebate is for low to moderate income families to electrify their homes, up to $14,000 in rebates. And you can see what qualifies here: electric stoves, heat pumps. Heat pump for space heating or cooling is $8,000. And again, this is a rebate incentive that will happen at the point of sale to be managed by the state. So there are income thresholds for this high efficiency electric home rebate. No rebates allowed if your income is greater than 150% of the area median income. And then you can see moderate income and low income, the potential rebates there. Okay, so logistically, I mean, we're going to walk into Home Depot or Lowe's or any other sort of retailer with our tax returns to prove this information. See, the logistics haven't quite been worked out yet. So the two rebates cannot be combined. You can see here what the opportunity is with using the heat pump rebate and tax credit as an example. So the purchase of a heat pump. As I mentioned, if you are a low income home, you have the potential to get 100% rebate up to $8,000. If you have mid-income, moderate income there, 50% rebate. And then there is also the incentive to the higher income homes, 30%, and that comes through Code Section 25C, right, the actual tax credit. So those, this illustration is just kind of demonstrating that the rebates may be more desirable to folks in the lower to mid income ranges than the actual federal tax credits. There's also incentives to multi buildings similar to the home rebate. Governmental, commercial, or nonprofit entities may also be eligible for these point of sale rebates. Again, more information to come as the states receive their funding.
All right, Jenny, are you able to see the Q&A? There are 2 questions in there.
Sure. First question, on qualified battery storage technology, would a set of 3 linked 1 kilowatt-hour unit qualify? Carrie, do you know the answer to that one off the top of your head?
This is a question that actually was proposed to Treasury, in writing guidance. The manufacturers are very specific. We manufacture units. We don't manufacture how they're put together. So the intent is, it is a standalone unit that could function as a refueling asset itself. It should qualify for the credit. If I link 3 of them together, I'm concerned about that linking. But I think what you're saying is, effectively they'd be wired, in a way that they could be, as a combined unit, send electrical power all back to the grid. I'm not sure I'd wire 3 separate units together. That's the part I'm grappling with. But anyway, I'm always an engineer on the side of my mind trying to figure out what you're doing. But I'll say we're waiting on guidance from the Treasury.
That's a default answer to a lot of this information, unfortunately, and it's slowly trickling in. The second question, and looks like final question, for home rebates, are there percentages of savings required to achieve the rebate? Was the baseline, in other words, 35% better than what? And that is cut in the energy usage of the home. So again, I can envision.
It's actually determined by the utility itself, that it does the comparison, saying you've achieved this status, by your energy consumption.
Right. So does that mean that we bring our utility bills into when we purchase our property as well? Tax returns and utility bills, is that what we envision happening? I don't know.
I'll say records are definitely where we're open. Keep the records.
Keep the records, without a doubt. Joe, Carrie, any final thoughts?
I'm good.
Okay. Again, we appreciate your time and thanks for joining us. Hopefully for all 3 of our Inspired Inspired Perspective series related to the Inflation Reduction Act. We hope to see you soon.